Hello, good morning, everybody, and welcome to the Daily Energy Markets podcast. It is the 28th of September. It's the last day, at least for the Middle East here, in terms of the quarter, the month, because it is a holiday weekend this weekend in the region, and Brent crude oil is knocking higher and higher, it seems, now at over $97 on Brent this morning in early Asian trade, up over 0.5% after the big surge yesterday. Let's kick off this morning with our longtime commentator, Ole Hansen, head of commodity strategy at Saxo Bank. Ole, welcome back. Is this a market, do you think, that's led principally by demand, economic strength, or supply constraint and general economic malaise? Your thoughts this morning?
Good morning, Sean. Well, I think looking at how the market has been behaving the last 3 months, there's no doubt that the rally that we're currently seeing unfolding has really kicked off in earnest when these production cuts, the latest round of production cuts was announced. And then we basically had the double whammy earlier this month when within a relatively short period of time, we had the extension to the year end announced by Saudi Arabia and Russia, and then follow that up by a higher for longer message from the US Central Bank. And these basically now are chasing each other. High energy prices is raising the risk of high inflation. That's driving up bond yields, it's driving up the dollar, and basically all adding to some potential demand malaise later on. But the wider market is most certainly signaling the recession risk that is basically here now. It has arrived, and it will probably arrive in the US in some shape or form over the coming months. So that obviously will revert the attention to demand. But for now, it's most certainly this man-made decision to keep supply tight, thereby forcing prices higher.
Victor Yang, senior analyst at JLC Network Technology, on the doorstep also of China going on a big holiday. What's the outlook from China? From a demand center, it's been surprisingly strong this year, at least from an oil imports point of view, but lots of inventories building. What's the outlook for China demand in the fourth quarter?
Well, for now, we see a surge in gasoline and jet fuel demand briefly because of the 8-day holiday from tomorrow on. And after that, we expect gasoline and jet fuel demand to retreat modestly in the last quarter. But diesel demand is seasonally strong now, is improving. So we expect economy to gain more strength in the last quarter too, which will push up diesel demand to some degree. As for the country's oil crude demand, well, prices had jumped to such high levels that they had dampened Chinese buyers' interest, and this could lead to a drop in the country's crude imports in the last quarter. Besides, it has built some stockpiles earlier this year, crude inventories. So when prices are near $100, the country will probably cut its crude imports.
Let's go to Bill Spindle, senior global correspondent at Cipher. Bill, just arriving into the UAE from, I'd like to call it. Sorry?
In New York.
Oh, you're still in the US?
New
Okay,
York.
well, that's good. That's good. Because we want to get a temperature from New York, from the US, the economic outlook there, the interest rate forecast of higher for longer. Ultimately, the demand center, the growth, there's a supply constraint, as Ole mentioned, but also the US economy continues to defy gravity. It has its problems, but it's still moving firmly ahead with full employment. How's the demand center of the US likely to hold up going forward into the fourth quarter?
Yeah, I think that's the concern that sort of cropped up after a brief celebration a few weeks ago that somehow the Fed may have miraculously pulled off a soft landing. Suddenly the Fed announced that, well, the fact that we didn't pull off a soft landing means we're going to be holding rates longer and higher. And that's, again, particularly in the equity markets, I think the last couple of days started to reflect those fears that might ultimately again push us into some sort of recession, or at least that's where the risks kind of lie. Not only with interest rates, but as Ole pointed out, is with energy prices higher. Inflation still really hasn't made that last little leg down from 4 to 2, which isn't actually all that little, because that's where the real work comes in. And the Fed seems to be signaling that it's going to do what it takes, which may mean, holding rates for quite a bit longer, and again, tipping or causing concern that is going to tip into a recession. We'll see where that goes.
Ole, how long do these two things coexist? I mean, the idea that you can curtail supply to elevate price, but at the same token, the battle for inflation dampens economic growth. I mean, can you cut your way to $100 despite economic health?
In the short term, most certainly, yes, you can. We just saw yesterday how the inventory levels at Cushing, which is obviously the pricing center for WTI, but also the delivery hub for some of the export out of the Gulf Coast, which is a lot of that has been going to Europe. That is not going to go away anytime soon. So for now, the focus will be on that tight supply outlook, and the demand story is probably only one we're going to which will attract increased attention as we move into next year. So for now, the price is likely to remain this elevated, simply because of the tightness in supply. But it obviously there's a lot of mechanics here that really doesn't work well together, and one is feeding the other, and that's that feedback loop we're seeing right now from high energy prices. We saw that yesterday after the inventory report from the U.S. Oil rallied again. Bond yields made a new high, and we saw the dollar make a new high for the year as well. So it's all interlinked, and obviously with oil prices going up, both in real terms, but also with the dollar going up at the same time. Just look at some of the prices that we're paying around the world. The Chinese cost of crude oil now is up more than 20% this year. It's in Turkey, it's more than 60%. In Europe, is also more than 20%. And that basically, it will have an impact sooner or later. But and it will add to the story that the Fed cannot both get inflation down without hurting the economy, and that's really their big challenge in the months ahead. Will they accept an inflation rate that is going to be higher than their 2% target? That I think is the main concern or main discussion they will have to have in the coming months.
Victor, one of the stories that continues to make big headlines around the world is the Evergrande property story out of China as a sort of a bellwether for the overarching construction and real estate sector in China, which of course is a massive part of the economy. How big of a challenge is that? Is this problem getting worse or getting better? What's your read on the scale of impact of the Evergrande and the real estate sector on dampening economic activity and growth in China?
Well, this industry has been a great concern, not just to the government, but also to the public this year, because a lot of people who have bought their apartments have not got their houses yet. And so this one has actually dampened the country's economic growth to some degree, and hitting diesel demand too, because a lot of diesel demand is from the industry and related logistics. And now we have been talking about how the situation stands here in China, but no more significant progress has been heard yet, or not much worse yet here at the moment. But as
and
for
how are they? I mean, it seems like you might say a slow motion car crash, but it's a bit like the recession that never comes. The crash of the Evergrande and the China real estate doesn't seem to arrive at a bit like the expectation that we see a repeat of what we saw in the US in 2008-9 under the subprime mortgage crash, which nearly pulled down the global economy. Is China avoiding that kind of destination?
Well, I believe China can avoid this one, and there will be a different situation, because in China, the government has a lot of measures to stimulate the industry, but it has to weigh the consequence to find a better way, not just to stimulate people to buy houses. For now, the local governments had taken some measures to stimulate the house purchase, including removing some restrictions and cutting the bank low interest to some degrees. So to some degree, houses purchase has improved modestly lately, but there's still a lack of confidence in the industry, and people are still waiting to find out how this would develop eventually. Yeah, so it remains a great concern, actually. Yes.
Bill, the other issue of concern today, I mean, is the sort of speaking of slow car crashes, the U.S. body politic in Washington seems to be scoring another own goal with the outlook that the government is going to actually shut down this weekend due to a lack of agreement around the budget and keeping the government open. Your outlook for that, is it a significant event? Is it more noise than impact?
No, I think it's fairly significant. It does look like we're headed for a shutdown, astonishingly. A small group of Republicans really seem determined to shoot the party in the foot politically. And it's a complicated political situation, too difficult to get your head around or even explain in some ways. But it does look like we're going to get a shutdown. It may not last all that long because it is so completely idiotic from a political standpoint, but getting out of, finding a way out of it may prove as difficult as it is heading it off. The Kevin McCarthy in the House, who's the House leader, is just in an almost impossible position. So we'll see how it plays out. Logic would tell you it wouldn't last very long, but given how hard it is to avoid at this point, they may find themselves in just as difficult a place trying to stop it.
And with it, of course, at least according to the U.S. Transportation Secretary, Pete Buttigieg, there will be 1,000 air traffic controllers, which of course are federal employees, put on furlough. So there will be certainly an impact and perhaps even a big impact on air travel in the U.S. And with that, of course, the movement of people and goods, it could add up to being somewhat problematic. Ole, the question ultimately, as we sort of get to the sort of heady heights of 97 and up dollars a barrel of oil, is and I suspect in Vienna and Riyadh and elsewhere they'll be asking this question, as we all do. How big an economic impact do these oil prices have, given that, $97 isn't what it used to be, and we survived 4 years in the early naughty or in the 2011-14 period above 100 average?
Well, that is the $1 million question, Sean. But it's also, I think it's worth just simply saying it's not just the price of the oil that's rallying right now. It's as I mentioned. It is also the added cost of higher funding costs because yields are moving higher as energy prices are moving higher. The dollar is moving higher as well, making it even more expensive. So it's basically this whole reaction function that potentially could have a stronger and bigger negative impact on demand than perhaps previously expected. So basically, rising oil prices into a recession, I mean, it tends not to go that well, and I think, and I would assume that OPEC would be looking at this as well, because clearly what we're seeing right now is not an attempt to create stable and balanced markets. It's more or less the opposite, having extended production cuts when they saw that demand was probably going to be quite strong into the final quarter. So I think we may be approaching a point where we may get an announcement from the Saudis. I can't really see it, it's in their best interest to see prices surge above 100 at this point.
Is it a kind of a 2008-9 moment, whatever the date was, that we knocked the bell on 147 and then went over a cliff?
Probably not there quite yet, but and what we're also seeing right now is that the speculative interest in the market, in the crude oil market, has been rising, obviously, as momentum has been as strong, and we've seen this big rally. But at the same time, it's worth noting that the half of the change in the positioning in the last few weeks or months has been actually short covering. So there's literally no shorts left in the market, in the crude oil market. That is, from a trading perspective, that is a big concern to me when the market, when we hit a peak, because there's a lot of longs in there that needs to find a short that wants to buy their position back. And if that short doesn't exist, then obviously there could be it could be quite cramped near the exit door. So we're not there by any means yet, but it's obviously a concern. And I think also we're seeing funds not extending their lens to the degree we've seen in the past. And I think that is the macroeconomic overlay that basically prevent them from going all gun blazing into oil mines, simply because they are the combination of rising oil prices at a time of an economic slowdown just doesn't go that well together. And also at a time where spare capacity held by OPEC members are the highest levels we've seen in a number of years.
Victor, I mean, we're looking for demand holding up here. Clearly, we've got the supply constraint story, and that's been underpinning this 30% plus oil rise over the last 3 months. But the demand lead is remaining solid, as we talked about, in China through the third quarter as oil prices rose. Imports into China were near record levels, and Asia as a whole is struggling economically. We're seeing manufacturing down in Korea, in Vietnam. So ultimately, my question is, can we have and sustain through the fourth quarter the coexistence of weak macroeconomic activity, like weak PMIs on manufacturing, weak outlook on the China real estate and construction industry, but at the same token, oil consumption, gas, LNG consumption going into what is the peak demand window for Asia in the winter remaining strong, and the sort of total volume consumption on energy remaining elevated and not subjected to weakness? I mean, this is the question, outlook for the fourth quarter across Asia.
Yes, well, and at the same time, we're saying when the economy is relatively weak, but consumption, say in China, has beaten some people's expectation. A lot has been saying that demand has been. Can you hear me?
Sorry, you dropped out there. You were saying that China demand?
Well, say a lot of people have been saying that demand has been weak this year, but
yes.
Actually,
well, they've been saying the economy has been weak.
Yes, because the economy has been underperforming expectation.
Mm-hmm.
But actually, as you know, crude imports, crude throughput had jumped this year. And actually, gasoline demand, jet fuel demand has been much higher than last year. And gasoline demand, for instance, has actually been close to previous record highs, say before the pandemic. And in August, the apparent consumption even surpassed the previous record and set a new record. And at the same time,
what's the explanation for that?
Well, people are traveling more now, and the sales of conventional fuel vehicles were still growing despite the impact of NEVs. So the country's gasoline demand has not peaked yet. It's still growing slowly. And jet fuel demand too. Now people are more eager to travel. So basically, jet fuel demand and gasoline demand has not been impacted much, particularly over the past few months, by relatively weak economy. And diesel demand is not as strong as some had expected, but it has recovered quite significantly too. And in the last quarter, we expect diesel demand to be seasonally strong. So if you are looking at the last quarter, well, gasoline and diesel demand in China can retreat modestly because of lack of holidays after the National Day. But diesel demand will be stronger, than the previous months. And the country's crude demand will not change much yet. And there have been a lot of talks about the country's oil product exports in the last quarter because the country released a batch of quotas on oil product exports at the beginning of September, permitting 12 million metric ton exports. And some market players were concerned whether the country would release another batch of quotas to push up its exports to stimulate its economy. So this has been kind of market highlights now in China and among the people who are interested in the market. And another issue is whether the country is going to issue another batch of quotas on crude imports, because some independents have not won their full quotas for the whole year yet. So this has been kind of, hotspot in China oil markets at the moment. Yeah.
I wanted to, Bill, get your views on slightly away from the front end of the oil markets, but it's still, I think, somewhat relevant. And I know that your publication, Cypher, tracks the climate story and energy transition very closely and very impressively, and get the views. Where is the energy transition risk? We're seeing increasing headlines, I think even in the FT today, that the momentum away from the energy transition, most notably by the European majors, and hence lack of investment in new oil supply. Your thoughts of where that balance is? Is energy transition under a weak wicket, as they say in cricket, is losing its preeminence as to where it was? Your thoughts generally on that narrative?
Yeah, I think we've seen a division of opinion and forecasting about where the fossil fuel markets are going over the next, 7-8 years, wider than we've really ever seen before, with the IEA coming out with a pretty aggressive forecast that all three main fossil fuels are going to peak by 2030. Simultaneously, you sort of had the World Petroleum Conference and oil executives from Aramco to Exxon calling that basically silly and dangerous talk. I think we are enmeshed deeply in the transition at this point, and it is pretty hard to predict where it's going. Partly because it seems, it's going to proceed in fits and starts, and as the starts get going and it starts to gain momentum, then it does bump into restraints, supply system restraints, and political.
But energy security sort of soaring back to the top of the political agenda in many countries, it kind of knocked energy transition from its posture.
Yeah, the combination of sort of these supply restraints, which have pushed up costs for renewable energy, like wind, for example, is in a real difficult spot right now, combined with these security concerns, have led to a sort of backing off. You've seen, and Victor can talk more about this, but you've seen, China more aggressively move into expanding coal production. But I still think down the road, the real question is whether India, China, a lot of these countries that are still expanding production of some of these things, particularly coal, ultimately, is that a security measure? Like, we just need this stuff in reserve just in case we need it, and then we'll see how demand grows, because it has been quite strong through summer peaks and stuff. Or at the end, is it just there in case, and winds up that again, China's huge build out of renewable energy really does do the job, and a lot of this coal just remains, less used than it would have, you might have thought. So we're in that transition, and you're
Mhm.
going to see it in fits and starts. And I think right now we're seeing a bit of the fit side. It's slowing
Well,
down.
there's no straight lines, I suppose. Let's get the survey question up and go to last comments. With the, this is the opening question: is surge to $100 oil demand led or supply constrained? Oil demand led or supply constrained? Ole, as we go into what is the holiday weekend here, Brent knocking on above 97. Do you see anything out there in the immediate sense that stops the momentum to 100, whether it be next week or in the coming period?
I think in the short term, no. The only thing should be a surprise increase in crude stocks in the US next Wednesday. But apart from that, the prompt spread are so signaling so much tightness right now that there is obviously a reason for that. So that is keeping the underlying momentum there. So and the correction we had just recently was a relatively shallow one, basically indicating that there's no appetite for trying to find the top at this point in time. So $100 is very much still on the card in the coming weeks.
I mean, it's interesting, Ole, that inventories seem to have come back to being a determining factor when for so long they seem to be a marginal subject. I mean, from a market critical point of view, low inventories in Cushing's, does that signal concern? Is it, there's not going to be enough supply next Monday when I pull up my truck, or is it just a sentiment?
I think probably for now it's a sentiment. We saw the same thing, Sean, when back in 2020 when the world just stopped moving and oil went negative because they were worried that there was simply not enough storage capacity at Cushing at that time. So that was the opposite situation. So a lot of this is still sentiment driven. That can change on a dime. But again, we need some significant piece of news, I would say, in order to change that focus. Right now, which really it does point to a market that wants to go higher.
Well, as we've seen, this is not a this week thing. This is now 3-4 months, 3 months plus on the run, well above 30% climb. Victor now at 97 and moving. But Victor, I wanted to get your thoughts on this closing on the in China. The sort of positive consequence, if you like, of the weaker economic outlook is that more Chinese are staying at home. They're not with the big holidays coming this week or the big sort of New Year holiday in January, that it actually results in more Chinese staying at home, consuming, traveling locally. And so in that sense, maintaining economic growth and strength in the country. Your thoughts on that? Chinese staying at home and they haven't yet got back to traveling all over the world like they were pre-COVID. You're on mute, Victor.
When you are talking about traveling abroad, yes, it's still far below the pre-pandemic level. And some international lines, for instance, the line between China and the USA is far below the pre-pandemic level. And it has a lot to do with the relationship between these two countries too, and some other countries too. And not just because of the China problem, it's also because of the resumption of some international lines too. And so now people prefer to travel domestically now at home, say for this National Day holiday, while 20% more of people are traveling than the same time in 2019. So we started to see travel jams yesterday and even worse today. So this is quite, it's just like the Spring Festival migration, we can say that, yes. So we still see a lot of travel in China, yes.
And that obviously will translate into economic well-being in China, and I think in a sense, sort of be contrary, another contrarian point to the overarching narrative that China macro weakness, but yet still a lot of domestic travel and consumption. Bill, last word to you with the survey result. Of course, you are not in the UAE yet, but you are coming 100% on that one. So always bad questions when you get 100%. So naughty Sean on that. Bill, you're coming to the UAE for ADIPEC next week. There is some rumors building that the oil and gas industry is going to make some big announcement or commitment towards the COP28 and getting their house in order. Your expectations for ADIPEC next week?
Yeah, I think that's going to be a big question in the next couple of weeks as we really drive towards the crunch time at COP, is to what extent the UAE's COP presidency is able to deliver on bringing the oil and gas industry in a pragmatic way, as Dr. Sultan Al Jaber likes to say, but I think one that is practical also from the other side of the table, and so what progress can be made.
Yes, it'll certainly be an interesting week at ADIPEC, the world's biggest oil and gas exhibition and conference, the gathering of all of the top brass, if you like, of the global oil and gas industry. And it could be synchronized with $100 oil, perhaps even if it comes that soon, or maybe the following week when we have our own Gulf Intelligence Energy Markets Forum in Fujairah. Will we have the triple-digit number for any of these big events coming up? But for now, it's 97.19 on Brent. And thank you so much for joining us today and seeing you guys back at the table. Victor Yang in China, Ole Hansen in Denmark, and of course, Bill Spindle in New York, all around the world every morning at 10:30 UAE time, bringing some insights to the daily energy markets. Thank you so much, guys. Have a good day and have a good weekend.
Sean.